Hi, it's Coach Drew with you here again. Today I've got a guest with me. I'm talking to Tim Lee from Advance Mortgage, and we want to talk to you a little bit. Well, actually, we're going to talk to each other, but we want you to listen because we're going to talk a little bit about mortgages and rates and markets. Tim, how you doing, bud?
I'm good. Thanks
Good.
for having me.
How long you been with Advance, man?
It's been 7.5 years now.
7.5 years. So you've done this a little bit. You've been through some different markets.
9 years in the industry, so coming up on 10 years next year. So.
Okay. So let's talk about rates. I know you want to get right into that, so talk to us about rates. What are you thinking about them?
Well, that's kind of the elephant in the room right now, that rates are relatively high right now compared to where they had been just earlier this year or the last couple of years.
Right.
I think that information is kind of out there, so people and the general public and buyers kind of know rates are a little bit high right now. I know you might have a little bit of a different opinion on that.
Yeah, I mean, I really don't think rates are high. I mean, I'm older than you and probably older than a lot of people watching. But, I can remember my parents having a mortgage in the high teens. When I was getting out of high school, I bought a certificate of deposit at 13.5%, which I think they're less than 1% now.
Right.
So when we're talking about high rates, we're talking about relative to the lowest rates in history, which is what we had the last couple of years. Really looking at, I think, very, very average rates. It's just been a shock because the Fed didn't do anything, and then did everything all at once.
Right.
And so I think it's more shocking rates than high rates, to be honest.
The speed in which that they increased, which is, I mean, that
historic.
That's like getting hit in the face and getting hit quickly. So.
Never in history, I don't think a rate's gone up so quickly.
Right.
So yeah, that's a huge surprise. If you're expecting 2% and all of a sudden it's 7%. And it really does impact the ability to buy. I think somebody who could have bought a $400,000 home at the beginning of the year is looking at about $320,000 now because of the increase in rates. Is that right?
I put some numbers. I was looking at like a $500,000 price point and then kind of ran some scenarios.
Right.
So the difference between rates being at 4% and 7% on a $500,000 loan amount is about $900 a month.
Yeah, it's huge.
It's a big difference, and that's something that if you're a prospective home seller, I think you should know too. When houses were flying off the market in 5 minutes, 24 hours, 48 hours, whatever it was, rates were a lot lower, and that made housing a lot cheaper. And that's kind of that gets into the inflation thing. And that's really why they're increasing rates, to make housing a little more expensive to control the price appreciation.
Right. Make it more difficult to buy, so there's more on the market, so prices don't keep running up the way they have been.
Yeah, exactly.
Yeah.
The other things that drove us to, with rates being so low for so long, I mean, I think the Fed, I'm sure, did some things right by getting rates down, maybe. I think that they were very late to bumping rates up.
Yeah, I mean, I do think the Fed, after their initial miscalculation, which that inflation was transitory, I think they were dead wrong. I think there's no doubt about that. But since then, I feel like they've done what they needed to do.
Right.
And I think we are really starting to see inflation come down. And then also sort of some future effects are built in. OPEC just cut oil production 2 million barrels and the price of oil fell. That tells you that the markets are not expecting to need as much oil the rest of this year.
Right.
So I think the rates are working. I think we're on track.
It takes time for that stuff to catch up. I mean, it doesn't happen overnight. I could see us having one more rate hike in the fourth quarter.
Right.
Or about another 3/4 of a point. That's my prediction.
Yeah.
And then I think they're going to wait and see for a little bit. So they'll do this one more. They'll say, look, we've really ratcheted rates up from 0 up to, I think that'll put us over 4.5%. I think at that point, somewhere 4 or 5%.
And that's their target, right? 4 to 4.5. Yeah, I think so. In my economic forecast, I predicted that they would do 2.5 increases, 250 basis points increases. I would prefer they do just 1.75. Honestly, I mean, I'm ready to take a breath and see what happens. Let things shake out.
I think everybody is.
In general, though, and I sell real estate, so I think it's still a good time to buy. You can't buy as much house as you could 6 months ago.
Sure.
But there's so many. You couldn't buy a house 6 months ago anyway because there weren't any available. I mean, it was crazy the number of offers we were getting on these houses.
Yeah. So that's where low rates got us. So 0% interest rate sounds good on paper, right?
Right.
That got us to 6 months ago, where literally you had to wait till a house posted on Friday, wait in line to go see it on Saturday.
Yeah.
decide on a life-changing decision that night, and then put an offer in.
That was probably beyond what you could really afford.
You had to waive your home inspection. You had to guarantee the appraisal.
Yep.
Some were unlimited appraisal guarantees. That means if the appraisal came in at say 400 and you were paying 500, you got to come up with that difference.
You got to write a check for 100K. We saw
Right.
a lot of that.
People were guaranteeing 20, 30,000, 50,000 over list price. So that's where the 0% rates got us to.
Yeah.
Now, that's not so much happening. Rates are higher, yes, we kind of know that, that's built in. You can adjust your price range and budget for that. But like Drew was saying, unless you had 50 grand more than you needed for down payment and closing costs 6 months ago, you might not be buying a house.
Yeah. It took some really clever stuff to get deals done. So I had a client that I knew they had some cash for an appraisal guarantee. So I went looking for houses for them that were underpriced, because I knew people looking in their price range would look at those houses.
Mm-hmm.
So basically what I was really looking for was a real estate agent that didn't know how to price a house.
Right.
Or that's unfair, that underestimated what the house was worth.
Maybe they're trying to create a bidding war, but if you cut that search criteria off, might not pop up.
That's
on
exactly what it is. If you don't price it right, your target audience may not see it. And so I found him a house that was priced. I don't want to get into too many numbers here, but basically it was about 40K below what I thought it would go for.
Mm-hmm.
So I went back to my client and said, let's offer 40K over. You've got 100 in the bank. Let's offer 40K over, and see if we get it. And we did. We beat everybody out. And the first thing that agent said to me is, there's no way this house is going to appraise. And I met the appraiser on appraisal day, and it appraised.
Right.
But about three more than we offered. So, but that was the kind of thing you had to do to have a chance of getting somebody in a house. If you thought you were going to go in with a VA loan or an FHA loan and offer list price, you're wasting your time. I mean, that was just not happening. Whoops, I am tearing up the set here. And now
before you get off that was one of the things that killed me, is that VA loans were being looked on as second-class citizens.
They absolutely were.
And that's not because of VA buyers, it's because of the VA loan product. The appraisers and the appraisals are seen as a little more stringent.
They are. To protect our veterans, to protect our service personnel.
Right.
That's why they're more stringent, because
Yes.
we don't want to move our military people into houses that are a mess.
Yeah, but it started to hurt them a little bit. I don't think that's happening quite as much anymore either.
I mean, I can tell you on that point, I do know listing agents, not me, but I do know listing agents who would get offers, and the first two things they would do is they would find the banks that weren't local, and they would find the offers that were VA, and they'd just take those out of the contender stack. They were just gone. They didn't even look at them.
Right.
And that's partially because it's so much harder to do an over appraisal with the VA loan, these sorts of things.
Yeah.
And it was just really tough. Now we're in a situation where it's changed so much. I've seen sellers offer home warranties. I've seen sellers offer closing costs. I've seen sellers offer to do repairs. 6 months ago, no inspection. Now, let me fix the roof for you.
Right.
So it's a big difference.
Yeah.
Prices haven't really come down, but the value you can get, I think, is much better.
Yeah. Another big one too, if you're a current homeowner and you're thinking about selling your current house, move to the next one, that can be kind of painful. Do you sell first, go move in with mom and dad for a little bit, or go rent?
Right.
Then move again. You're having to move the whole family twice. Something that had been more common, and I'm seeing come back a little bit, is home sale contingencies.
Yep.
So you're a buyer. You are going to put an offer in on the next house. That offer is contingent on the sale of your current home. So that means you don't have to proceed with the sale until you get your current house sold. Why is it important to sell your current house? Well, you're going to eliminate that mortgage and that mortgage payment, and you've got more equity than you probably have ever had.
Sure. That
you're going to need for down payment. So you're going to make 50, 100 grand on your sale. There's your down payment for the next sale.
I want to circle back around in a minute and talk about equity and wealth and what homeownership has to do with that. But let's talk a little bit more about rates. So if people are thinking rates are 7%. How many mortgages are you writing where somebody's actually paying 7%?
I've seen a couple, one or two.
But that's not the standard.
No, I mean it's 6.
Yeah.
And mortgage bankers right now are very hesitant to quote rates. It's not because we're trying to hide anything, but it's because it's so volatile.
Right. We don't know what the Fed's going to do. We don't know what's going to happen in the bond market. if you don't know, mortgage rates really are tied to the bond market, not the Fed rate, but the Fed rate impacts the bond market. So it's correlated, but it's not causal.
Yeah. So your 10-year Treasury bond, if you're looking at any one particular thing, usually that is in lockstep with mortgage interest rates. But yeah, I mean, I came from a closing this morning. They were under 6% on a VA loan. I've got several loans in the 6s, again, maybe 1 or 2 in the 7s. Now, another thing you're seeing is you're probably going to have to pay discount points to get a rate. What's a discount point? Basically, you can pay more money up front. It's kind of like prepaid interest to get a lower interest rate. Most of the big investors out there that kind of set mortgage rates, we're seeing that they want some form of discount points just to get a rate. I think that they want to get that money up front.
Yeah.
Because they're fearful of a refinance boom and people closing out these high rates and getting a lower rate early. So they'd rather get their money now than the monthly interest payments.
There are some experts that think we're already in a recession. There are some that think it's coming. There are some that think it's not going to be very bad, and some think it's going to be very bad.
It's kind of all over the map.
So the safe thing to do is to get your money now.
Right.
Right?
Yeah.
Because if it is a very bad recession, the way the Fed's going to respond is they're going to chop rates, and then you get that refinance boom you're talking about.
Right.
So what is the sort of the best rates you're seeing now? Where's an FHA typically?
So FHA and VA are typically a little bit lower than conventional, right? Usually about a half a point. So I would say, again, depending on what you want to do with points, you're looking low 6s. Maybe you could get into the 5s on a good day. Conventional, again, about a half point higher than that, so 6.5 to 7%. There's a lot of factors that can boil in there: your down payment, your credit score, the type of home. Sometimes condos are more expensive than detached homes.
Sure.
So there definitely are a lot of factors that are built in, and it's interesting. I joke around. People, when rates were in the 2s, we got very into the minutia. Oh, is it 2.5? Is it 2.625? Is it 2.875?
Right.
Now it's like, with the rates higher, it's 6 or 7%.
What's the difference, right?
Right. I was gonna say, I think if you're gonna stay in the house for 2 years, I think you're gonna refinance that loan at some point, probably in the next 2 years. Some think it could be sooner. We'll see again if we go into a deep recession. And that's kind of what I'm seeing the Fed doing with hiking those rates up, is they're kind of reloading their ammunition.
Yeah, absolutely.
When rates go to 0, they're like, okay, I'm all out of dry powder here. Now they crank rates up. Well, that gives them something that they can crank back down.
Right. So the Fed, in case you haven't heard this a million times already, has 2 jobs. Their first job is to maintain a high level of employment, and their second job is to maintain low inflation. As people are discovering now, and as the Fed has known for a long time, those 2 goals are actually contradictory. So you have to balance them in economic terms. When you have higher unemployment, you have higher inflation. So to have low inflation and high unemployment, or high employment, low unemployment and low inflation, is very difficult to do. So when you cut rates to 0, and your only tool to meet those 2 mandates is to cut rates, what do? You're out of tools. So you've got to raise rates to put the tools back in the toolkit.
Right. And there were, I think Japan and some places in Europe or the UK went negative.
Absolutely.
We don't want that. That's not a sign of a strong economy. You're paying the banks to hold your money, right?
Yeah, that's your country's currency going belly up, is what that is.
So that's not good.
Yeah. We've avoided that. Chairman Powell and the Fed have come in for a lot of really harsh criticism. And I think last summer maybe it was justified, but I think as we've gotten further down the track, they've done what they needed to do.
Right.
What they do the next quarter is going to be whether they're which type of goat they are, the goat or the greatest of all time.
You got to give them. They've stuck to their guns this year. I mean, I don't think people. It's funny. I'll go back and look like Freddie Mac put out some predictions earlier this year, and they'll go, rates are going to hit 5% by the end of the year.
Yeah.
Well, they hit 5%, but that was in June.
Yeah, that was at a run.
Right. That was easy. They got that one.
Yeah, I knew that, and it's been funny. I've been watching the home appreciation estimates that come out, and 4 months ago, everybody's saying, "Oh yeah, home prices are going to increase 5% in 2023, 7%, 8%." Right. And I was like, "You guys are whack. There's no way." And now they've all readjusted, and the average now is about 2%. Okay. Which I think it could be 3. But again, it's like 6 or 7, 2 or 3.
And what was it the past year over year? Like in June, wasn't 10 or 20%?
It was 10 or 12%, I think, in our market. and I think we've had a 20% year in our market recently. So it's just been nuts. I mean, I did a little thing on appreciation on my blog earlier this week. So we had 69% appreciation nationwide, I think it was, over the last 5 years, and almost 300% over the last 30 years. So that tells you two things. Homes appreciate in value by a lot. In the last 5 years have been crazy. And it's really been the last two.
Right.
Yeah.
And that's like, and that's the thing about that word appreciation. So home price appreciation is going to be down next year.
Sure.
But it's still appreciated.
Yeah.
So it's not going up 10%, but it's 2% growth. That house that's $300,000 this year is going to be 2% more expensive next year. So yeah, that's kind of, I don't see anybody predicting that home prices are coming down.
Yeah, there is one outlet out there that is predicting it. They're calling for about a 2% drop in home prices, but I think everybody thinks they're wrong. So we'll see.
Right.
And you're going to have some markets. You'll have some rural markets or some markets where factories have closed, things like that, where absolutely prices are going to go down. But that's going to be the exception, not the rule. Nationally, I think we'll still see home price appreciation. And so I'm a CNBC guy. It's on in the office all the time when I'm not talking to somebody on the phone.
Yeah.
And it amazes me some of the stuff they put on there. So they'll say all sorts of different things, and they talk about, home appreciation could be down 75%. And a lot of people hear that and they think, oh my gosh, housing prices are going to fall through the floor. No, it just means that instead of increasing by 20%, they're going to increase by 5%.
Right.
It really is in how you use the language when you talk about these things.
That's some interesting word craftsmanship there.
Yeah, exactly. It's almost like a double negative.
Right. The appreciation is decreasing. Well, it's still appreciating, right? Just at a slightly lower rate. A more normal rate, 2 or 3%, I think is a pretty healthy real estate market.
Yeah, I mean that's in line with the Fed target for inflation.
Yeah, when you compound 2 or 3% year over year.
Yeah.
And you're a homeowner for 10 years at 3% a year, you're building some serious equity.
I mean, I started investing in real estate in 2009. The home I live in, I bought in 2009 at the bottom of the crash. I got it at about $100,000 discount from where it had been on the market just a year before. I saw that deal, I couldn't walk away from that, right? But here's the thing, that house didn't add to my net wealth because I rented it or because I sold it. I live in it. I make my housing payment every month. So every month I own more of that house is the way that works. And every month the market continues to appreciate the value. So I've probably got about $100,000 in earned equity. Right. And about $250,000 in market equity.
Right.
The price of the home has almost doubled in 13 years.
I think a lot of first-time home buyers struggle to make that piece because they look, if you've been renting for a long time, you look at your rent, your housing expense as an expense.
Right.
When you're a homeowner, yes, there are expenses. Yes, you're paying interest. Yes, you're paying taxes and insurance.
Sure.
But you're also paying a little bit of equity every month. You're paying principal.
Yep.
And like you said, the other big benefit of that is I own this asset that also provides me housing that is historically one of the safest things and safest investments you can buy.
Yeah. And some people will say, oh, well, that equity's locked up. You can't use that. That's not really true, especially after a while. When we had been in our house, I'd have to do some math, about 9 years. I'm an entrepreneur outside of real estate. My wife and I started a company. We needed some runway. So we actually took money out of our house.
Did you do a cash out refi or equity line?
We did an equity line.
Okay.
Yeah, we did an equity line, got a great rate on it. And that's how we funded our business going forward. And that was a company that ended up being valued at about $11 million. So that was well worth the expense. I think we were paying 3%, something like that. It was 4%. It was well worth it to get that company going and up to that level. And it's funny. I've done a lot of different businesses. I've worked in the corporate world and through my work in the corporate world, I've added about $250 million, I calculate, to my owners and shareholders over the years. And then I've started several companies of my own to different degrees of success. A couple very successful. One I sold and basically got out with a break even. Mm-hmm. These were fun things to do. But I honestly feel like if I had just focused on real estate from the beginning and just done that, financially I'd be so much better off because because of the appreciation. It's unearned income that you get year after year after year.
Right.
Well, not income, unearned wealth.
And it's not taxed until you sell, right?
I mean, that's the other thing. You know, if you're a small business owner, you know that every time you tie your shoes, it's a taxable event.
Right. Not only are you not getting taxed, I mean, that mortgage interest is tax deductible.
Tax deductible. I have written off so much mortgage interest. It's one of my favorite things in the world.
I'm sure you being an entrepreneur, I'm sure you're a Shark Tank fan.
Oh yeah, absolutely.
That Barbara, I've heard her say this a couple times. She's the New York real estate shark
mogul. Yeah.
She said, I don't know the exact numbers, but she said she made something like $1 billion selling real estate.
Yeah.
She also owned the building that her firm was in.
Right.
She made $1 billion selling that.
I mean, there you go.
Like I said, the numbers might not be exact. Maybe it's $500,000. She made as much money selling the piece of real estate as she made
selling real estate.
Selling real estate.
Yeah, you know, it's funny. New York real estate's a world unto its own.
Right.
That is actually one of the markets where value might go down because so many people don't have to work in the city anymore.
Mm-hmm. Sure.
But you know, yeah, she's right though. She's a genius, and you know, Barbara has another great quote that I love. Shoot the dogs early. If something's not working,
right,
dump it. And that is, you know, that's something I've lived by in my business career. I have never, in all the time I've been investing in real estate, 13 years now, I have never felt like I needed to run away from it at any point. And you know, when the market crash came in 2008, 2009, I wasn't happy because it was so bad for the country, but boy, was it an opportunity.
Right.
And I feel like you know, there's great opportunities out here now. There's, you know, opportunities to actually buy a house when you couldn't buy one for the last couple of years. And the stock market is in the tank, man. If you've got a few extra bucks to put in the stock market, now's the time.
Right. Yeah, that's another one, depending on the day. I think it was when I saw you last Thursday. I turned on CNBC in the morning. It was down 2%.
Yeah.
After lunch, it was up 3%.
Yeah, and I think today, between today and yesterday, it's up 5%. It's volatility.
Yeah.
And this is what's happening in all the markets. And this is why, like you said, people are willing to do more buy down on points because they don't know what the future is going to bring.
Right.
And that's one of the nice things about housing. You know, I love the stock market. I'm not saying don't invest in it. There are very few real investments I wouldn't invest in. I even day traded Bitcoin for a little while,
mm-hmm.
Which is an absolute scam. But that's a different podcast. The thing about housing though is that everybody needs to be housed.
Yeah.
So whether you're doing rental properties or whether you're buying your own home, everybody needs somewhere to live, and we're not making enough housing in this country. We're 5.5 million homes short in the U.S. to meet demand. So for the foreseeable future, at least the next 5 to 10 years, we're going to see housing appreciation continue. And once we get out of whatever sort of situation we're in now, a mild recession, a coming recession, whenever we get back to the situation that the Fed feels like they've got to lower rates, housing appreciation is going to go bananas again.
Right. And
it's going to appreciate regularly for a while, but we are going to see another jump. So I think it's a really good opportunity to buy.
Yeah. And anybody that wants to compare it to 08 and 09, I mean, that market was really propped up on bad loans.
Yeah.
That's not happening. I mean, if anything, the market is stricter right now. I mean, we got the mortgage. I wasn't around back then, but the mortgage industry got slapped back into place pretty hard.
Yeah.
And those rules are still there. So these are good loans that we're making.
Yeah. So I first got an inkling that the market was corrupt then in about 2006 or 2007. There was a guy in town that used to do a radio show where he talked about doing these great loans and laddering properties, right?
Mm-hmm.
And you're going to ladder these properties out, and you're going to rent them, and they're going to always appreciate. So if you ever need cash out or anything like that, you just can sell one of your properties.
Right.
And that was...
And real estate always goes up.
And real estate always goes up. And that was... It's funny. I had a story about that. So that was what everybody expected in 2000, you know, before we hit 2008. And so I was like, man, that sounds good. He's like, well, sit down and talk to my guy, my officer. He got his loan guy. And so I sat down and talked with him. My wife is great about keeping records. So she bought our little portfolio with our W-2s and our tax records and all this stuff. And we were to sit down with this guy. And he's like, oh, I don't want to see any of that. And we're like, what? It's like, yeah, just tell me what you make. And I'm like, well, we can show you one. He says, no, just tell me. Just give me a number.
Mm-hmm.
And I said, well, let's add it up. He's like, well, how much house do you want to buy? Because what I need is the number that's going to buy that house.
Right.
And so what we encountered was something called a ninja loan. No income, no job. It doesn't mean you don't have to have a job. They just didn't verify. They didn't care if you did. And that was because of the way they were packaging these mortgages and selling them off to the big banks, which is where they became toxic assets, which is what destroyed the market.
Right.
Is that a fair summation?
I learned most of that from The Big Short, which is a great movie.
It is a great movie.
Really, it's funny. It's gonna be that. I love that author, Michael Lewis, Moneyball, and all that stuff. But
one of my other favorite movies.
Yeah, great movie. But yeah, that's exactly what happened. They were repackaging them. They would stick them in there with the good loans, so they didn't look so bad. But in that movie, I think they said if 6 or 7% of these loans go bad, it's going to topple the whole economy.
8%.
That's what happened. 8%.
Yeah.
Yeah. So.
Yeah, it was 8%, and when people started shorting the housing market, it was already at 4%. It was already a train on the track.
Yeah.
And so that's what's not happening now. We don't get too deep into that. That's what's not going on. We put on all sorts of controls and regulations after that happened to make sure it couldn't happen again. The quality of loans now compared to 2008 and 2009 is night and day.
Sure.
So it's a much more stable market. So if you're waiting for another big short, if you're waiting for another big crash, I'm afraid you're going to have to wait a very, very long time.
Yeah. And you talk about the supply and demand deal, and that's just population demographics. I'm a millennial. I think that's the largest segment of home buyers right now.
It's also it's the largest segment of home buyers. They're also in their prime home buying years.
Which is usually about 29 to 31.
And it's the largest generation in U.S. history.
Yeah.
So, I'm a Gen Xer. I never had trouble finding a house because there were so many boomers that had come ahead of us that needed houses.
Right.
And so they were downsizing. They were moving into retirement homes, new condos, things like that. Now you've got a situation where the younger boomers want to downsize, the second largest generation in American history. At the same time, the largest generation wants to buy that first home.
Right.
So they're literally competing for the same houses, and we just don't have enough, which is why prices are going to continue to go up in the long run.
And that's always so interesting because a lot of those generations are very different, but they want a lot of this. A lot of them want low maintenance. They want social. They want amenities.
Yeah.
So that,
another thing that's funny is they're both sort of conditioned by media. The younger people because media is such a big part of their life, and the older people because they're sitting around watching HGTV.
Yeah.
They're sort of conditioned to have sort of the same norm. One of the reasons we're in the situation we're in now was because the boomers didn't understand the millennials. They really thought they were something different. If you listen to the boomers coming out of the housing crash that were the experts and the economists talking about, well, these millennials, they don't want to have kids. They don't want to have yards. They don't want to, it's like they were a different species or something.
it was just a little bit later. It
wasn't
they were
20
just
young.
to 25. It was, we were 25 to 35, get married, have kids, do all those things.
Yeah, you wanted to have fun when you were 21, like you had some sense.
At some point.
Yeah, but that was they really, I think, to use one of my favorite non-words, misunderestimated how much millennials would want to have a family and a home, and so we didn't build enough. We built too many apartments and not enough houses, in my opinion.
Right.
So that's where we are now, and that's why home prices are going to continue to appreciate. So big picture, where do you think the country's headed the next year?
I wasn't prepared for that question.
Okay, the housing market, let's say.
I'm thinking we're pretty close on the predictions. 2.5 point raises or 1 3/4 point raise. So close to one more raise. Maybe we touch 8% on rates.
Which would be a little higher than average.
Right.
Yeah.
And then I'm thinking we start to see a trickle. It's not going to happen overnight. It's not going to come down as quickly as it went up.
Right.
But a couple of years ago, if you had rates in the 4s and 5s, that's still a really low rate, historically speaking.
I originally bought my house at 4%, 4.25%, and I thought I was killing it.
Yeah, me too. When I bought my first house, it was 4 1/8.
Yeah.
Refied to 2.875, and I didn't realize how good we had it at the time. But we might not see that again. But if we get rates back down, even low 6s, which is kind of where we're at now, at 5s or 4s, that's a really normal housing market. Again, I still think we're going to see home price appreciation.
Yeah.
Mostly because of what you just said about the demand. The demand is there. So the builders take a long time to catch up, to ramp up.
Sure.
That's one thing that the pandemic did have a legitimate effect on with supply chains and building and all that stuff.
The cost of materials to build a home.
So that was definitely an issue that we're still catching up on.
Yeah.
Economy-wise, like you said, are we in a recession? Is it going deeper? Is it going to be a nice? We've already touched bottom.
So I did one of my majors as an undergrad was economics, and you know how the answer to every question you ask an economist starts. It depends.
And it's something you never give a definitive timeline either. Because if you wait long enough, you'll always be right.
That's right. That's right. That's why I never say by the 30th of October in my financial forecasts.
Yeah.
30th of October, what year?
Yeah, there you go. So I was just a marketing major, so we didn't get into all this nitty gritty on the econ.
Yeah, but it's every time you ask an economist a question, the first words out of their mouth are "it depends," because it does, and that's why every economist has a slightly different opinion. And some of them have really different opinions. But I think big picture, the economy flows the way it flows. We see the same sort of peaks and valleys throughout history. There's a few rare events like 2009, like the stock market crash in 1929, that are brought on by some exogenous factor, some illness in the system that has to be corrected. But that's not where we're at right now. And I think we're going to see, I think we'll probably see by next summer, we may see an easing back on rates. Not a big one, a little bit here and there. If you've got a good job, if you're in the military or you're a teacher or you're somebody who's not likely to be laid off, you almost want to cross your fingers for the recession to be a little bit worse over the colder months, so that when we get into the warmer months, rates will be coming down.
Right.
I don't want that. I don't want anybody to lose their job, but I understand that for inflation to cool off, we're going to see some job destruction.
Well, and that's the one thing. The Fed's unemployment's 4% right now.
Yeah, little below.
Right, so that's a great unemployment number.
In economics for years they taught the natural rate of unemployment was about 6%. You've always got 6% of the people who aren't working. So when you get below that, you're really in a hot labor market.
And that's the other number, the labor force participation rate. That's getting a little better too, right? I think I heard there's more people working now than before the pandemic.
It is. We've gotten back to 2019 levels, and we've had some. One of the things that we've done in this country that's really hurt labor force is we've let so few people from outside the country come into work.
Right.
People don't realize, and I'm not just talking about farm work, although that's certainly huge. But when we're talking about, doctors, engineers, we've made it much more difficult for them to come here to work. And so that's created a lot of slack in the employment market that we're having a hard time taking up, which is why the market's so hot, which is why wages go up, which is why prices go up partially. There are other reasons as well.
Right.
So it's all a big happy ecosystem. Yeah. So, but anyway, so we've gone way into nerd territory now on the economics, so we'll stop that. But anyway, so yeah, I think next year I think this year is going to be okay. It's not going to be a disaster, but I think next year we'll start, especially by summer. People have to move in the summertime a lot of times. Trying to get moved before school years start. So I think we'll see the market get a lot hotter again in the summer, which means there'll be fewer houses available and appreciation will come roaring back, which means the cold months now is the time you want to get in there.
Yeah.
When you can get those concessions before prices start going up again. And honestly, if you get a 7 or 8% rate now and they chop it to 5 in the summertime, you can refinance. Or you can just ride it out. It may not even be worth refinancing once you really get into the math.
Then you have a conversation. That's one thing. Hey, do I want to buy right now? Well, two things happen with the rates. Rule 3: they can stay the same, they can go up, they can come down.
Yeah.
If rates go up, you're going to be happy you bought now while they were lower. If rates stay the same, okay, no love lost there. If rates come down, even better, I can refinance.
Yeah.
So
if you're going to be in the house long enough to make it worth it.
Yeah. And at that point, that's a whole different calculation. It's really about how long it's going to take me to break even on the cost of the refi, because there are costs. But that option's out there. I mean, we did a lot of refis the past 2 years.
Yeah.
People that thought they had a great rate at 4% and then got it down to 3 or below.
Yeah. Marry the house, date the rate, right?
Exactly. Yeah.
The rate is not forever. And then there's also, lower interest rates on 15-year mortgage, 15-year conventionals. There's ARMs now. What was do you have an ARM special?
We've got ARMs, but they're, because of that volatility we talked about,
right?
We're not seeing the rates as good as you would think that they would be.
Right.
I think the investors think rates might come down. So, I mean, at the end of the day, these banks are for-profit companies. They like rates being a little bit higher.
Sure.
So they don't want to lock you into an ARM and then see that rate come down. They would rather you do a 30-year fix.
Sure, absolutely.
Maybe you're going to refinance it, but hey, remember you paid that point up front, so
Right.
they got that money up front.
Right.
So the banks are smart. They're going to hedge. They're going to be profitable.
Right. I mean, I think the key takeaway is that financing is a little tougher now. The amount you can finance is a little tougher, but at the end of the day, you can get into a house, which was so much harder to do just a few months ago.
Yeah.
So now you can buy a house. You can always adjust your mortgage product later down the road.
Sure.
And while you're buying now, you're building equity. You're building wealth that you can put into your next home, or you can put into your kids' education or into your retirement.
Yeah, I would say if you're thinking about buying, whether you own now and you're thinking about moving up, whether you're renting or living at home, just don't be afraid of the market. I mean, Drew and I are both here local. We'd be happy to help answer any questions you have. I think we didn't even get into renting. I think no matter what the rates are, I mean, rent is 100% interest, right?
Yeah, absolutely.
If
You get no wealth for paying rent.
I moved back home after college. It was nice not having a housing payment, but I built no wealth, living at home.
Right, right.
Whereas, again, it might hurt a little bit at the beginning, and I was so terrified of my first mortgage payment.
Me too.
But
Me too.
Then
I was so glad I did it a few years later.
then you look back and say,
Yeah.
oh, that wasn't so bad.
Yeah,
And it expands. So you take that leap of faith, bet on yourself. And
that's what it is. I mean, if you're afraid of the mortgage payment when you're buying your first house, what you're really doing is you're doubting yourself. You're doubting your ability to keep up with it and to adult.
Mhm.
Yes.
I think that is a verb now.
Yeah, my daughters use it that way. But you shouldn't. You can do this. This is something you can handle. If you're just an average everyday person that gets up and goes to work every day, you can do this. It's not as scary in retrospect as it is at the front end.
Right.
But yeah, so I think that's a great place to call it a day. I really appreciate you coming and talking to me.
Yeah, thanks for having me.
Oh, absolutely.
Okay, can I do one more prediction?
Oh, yeah. Yeah.
It's postseason baseball season.
Oh yeah. Who do you like?
I'm a Phillies fan.
Ugh.
We're having a great year.
Okay, I'm a Braves fan, so we wouldn't have done this
here
if
we
I'd
are.
known that up front.
October 18th, so the Phillies just beat the Braves in the NLDS. NLCS, Phillies Padres starts tonight. We'll see if the Yankees and Guardians can finish their series. I think they were
Taking forever, huh?
a couple big delays. I like Phillies over Astros in 7.
Ah.
Astros are going to be tough.
It's going to be Astros over Yankees.
Well, that's ALCS.
Yeah.
Then what about World Series?
World Series, it's going to be Astros over Padres.
Okay. We'll see.
Astros go all the way this year.
These predictions we'll know a little sooner than.
Yeah, and they're less likely to be correct. So you like the Yankees this year? What do you think?
I mean, they're great.
Yeah, I mean they're a fantastic team. I couldn't believe the implosion of the Mets. I was happy for it, but I couldn't believe it.
The Mets do this.
I mean, they are a walking lesson in heartbreak.
Yeah. And
it's got to be hard to be a Mets fan.
When you can't take anything away from the Braves too, because they played amazing baseball to catch the Mets. The Mets played like 500, but the Braves they were on fire in the second half.
Oh yeah, absolutely. So anyway, we're getting away. So that's enough baseball talk. Maybe we'll do a separate show just to talk about baseball. But absolutely follow me on social. Do you have your social handles off the top of your head?
I'm behind the times. I'm on Facebook.
I'll put them in the comments.
Yeah, you can find my Facebook page on there.
And absolutely go to home-run-team.com to sign up for my newsletter or to get my socials, my Instagram feeds on there. And you can also contact me directly through the website and get my phone number to give me a call. And anytime you need anything, let me know. We're the Home Run Team, and at the Home Run Team, we want to be your real estate advisor for life. So thanks for watching.